tonight we have Ava Benesocky, who most of you know and have met before. Ava is the managing partner of CPI Capital, and she is in the business of private equity wealth building through real estate. So her and her partner focus on predominantly US real estate investments. And she's going to talk to us tonight about an investment that she has in Arizona, which would be the first investment that CPI has launched in Arizona. They've got 4 other investment properties in the US, and they're mostly in
the Sunbelt States.
Sunbelt States, right. So this is the first time going into Arizona. The investment opportunity that Ava is going to feature tonight is called Corbett Village Homes, and it's quite unique because it's 71 purpose-built rental houses, which is kind of neat because we always talk about apartment buildings or, you know, multifamily style buildings that are more, you know, stacked. And this is actually a purpose-built community of rental homes, which is, I find very, very interesting. And of course, we've all heard all the stats about Arizona when we've been at, you know, if you've listened to anything that Ozzy talks about investing in the States, Arizona is always a really hot market and a big growing market. Lots of people moving into the area, lots of industry, lots of head offices. I think it's really interesting that there is a purpose-built rental community of homes, which is so different. So pretty excited to hear what Ava has to share with us tonight. So it's not going to be like our traditional cash flow crunch where we look at the spreadsheet that Liza usually populates and we kind of work through the numbers together. Ava's just going to crunch those numbers for us and tell us about what this opportunity looks like from a cash flow perspective or return on investment. So it's a bit different. We're not looking at an individual property, but you know, I'm invested in quite a bit of private equity myself. And as far as a passive investment goes, your due diligence is the same. So this cash flow crunch really does apply across the line to this type of product as well. And I think it's a really interesting format for those people who aren't really familiar with investing through private equity. Ava will give you a great snapshot of what that looks like tonight. So it's not always active investing that you have to be doing. There's lots of opportunities to be passive in the same type of asset class and product that you would normally be looking at being active in. And Ava and her partner do all the active work for you. So that's what makes it so great. So for that, I will pass it over to Ava and she can share the opportunity with us.
Thanks, Joan. Yeah, and I'm excited to chat with you about this because as you mentioned, you've invested in private equity before. So I'm going to be excited to answer any questions any of the ladies have. First of all, I want to say thank you to the people that are in Ontario for staying up so late to come tonight because I know my bedtime's at 9:30 every night. So I appreciate you, ladies. So yeah, essentially, just before I jump into the slide, I think everybody might know me here. If not, I'm very passionate about helping people build wealth passively through real estate. And my partner and I, Ava Benesocky, we have a combined 25 years of experience in the real estate sector, and we're really excited to be offering retail investors, the everyday people, access to institutional investments, which were really historically reserved for you know, high net worth individuals, institutions, funds, and everything like that. So is everybody here tonight Canadian? Is there anybody from the US? Everybody's Canadian. Love it. Okay, good stuff. So for my Canadians, couple things before we jump in is, I know I'm presenting a deal from the US, so right off the top of your mind, you're probably thinking, oh God, there's cross-border accounting. You know, right away, you're probably thinking of some pain points that exist. We've created a tax-efficient structure that allows Canadians to really have a streamlined investment process. So no filing US taxes to the IRS. There's no obtaining an ITIN number, none of that stuff. You're strictly dealing with the CRA. So my company really does take care of all of the tax implications really, and we provide you with a tax slip every year and you take that to your Canadian accountant. So I just wanted to share that off the bat because that is a big change that we just actually shifted into for our last 2 deals. And it was a huge relief for a lot of investors because a lot of investors are like, oh God, you know, I already hate dealing with the CRA. Now I have to deal with the IRS. this is too complicated, I don't want to invest kind of thing, right? So we've really streamlined that even more so, and partnered with one of the top accounting firms in Canada. So we're excited for that. CPI Capital, we have closed on 3 multifamily acquisitions, one being in Orlando, Florida, Charleston, South Carolina, and one being in Houston, Texas earlier this year. Now, tonight I'm going to be presenting something called build to rent, single family rentals. So this is an asset class that we're really excited to be introducing to our retail investors, because it's an institutional quality asset. Not a lot of retail investors have access to build to rent. And just a quick story on the build to rent: for the last 5 to 6 years, institutions have been buying up and deploying billions of dollars into this asset class. Blackstone is a perfect example. And we've had our eye on the build to rent asset class for about a year now, and we ended up coming across this impeccable opportunity that I'm going to be showing you ladies tonight. And I can talk to you a little bit about the story, but there's a couple reasons why we love build to rent. I'm going to go through that, and then I'm going to also go through this opportunity, the numbers, and of course the region and the area that we're purchasing in, and why we feel like it's just such a diamond in the rough. So anybody that knows us here at CPI Capital, we don't just do deals to do deals. We're very particular, and when this came across our desk, even in this downward market, we are so excited about it because of the certain key points that I'm going to touch on tonight. So with that being said, I'd like to present to you ladies the Corbett Village home. You can see here, this is actually a rendering of the project. It's right now, it's actually dirt, and we're going to be going vertical on this project starting in November. So coming up real soon here. So what I'll do is I'll just head to the next page. This is again a street rendering of the project. So what you see here is what is actually going to be built for us. Beautifully designed architecture, modern and low maintenance properties. And then of course, ladies, before I go, oh, can you guys see my screen? I think it's just loading right now. It's being a little
Yeah, it's just loading.
It's loading. Well, while it's loading, I just want to go through some forward-looking statements and some disclaimers. I need to mention this, that there will be forward-looking statements and some forecasts and assumptions in this presentation, as well as some discussion of our past performance. So past performance does not guarantee future results. And like any investments, it's important to review and understand the investment that you're making. So we do encourage everyone to work with an independent tax and legal professionals. And CPI Capital is a real estate investment firm in which all of our Canadian securities are sold through our exempt market dealer, Front Funder. So Front Funder is licensed by the Securities Commission across Canada. I'm going to try to go to the next page here, and for some weird reason that one wasn't loading, but it's all good because it's just a disclaimer with a whole lot of words on it. This page is really important. So for all you ladies that are mostly probably active investors, you all know what the development process is when it comes to either building or if any of you have done development before. It can be quite risky, and it can be quite there can be a lot to it. So we highlighted before we presented the deal that this is actually an acquisition deal. It's not a development deal. So even though it's bare land and we're going to be building the properties to rent, this is not a development deal, and we have a locked in fixed price. So what I mean by that is I have to tell a quick backstory. This deal, we noticed that a builder in Tucson who's been building in Tucson for 38 years had a beautiful piece of land that he was going to be building a 71 home community on. We approached the builder, award-winning builder, impeccable reputation, and we said, hello, Mr. Builder. We see that you're going to be building this community here in this infill parcel of land. We want to buy all 71 homes from you. The builder was, to his surprise, never has had that happen to him in 38 years. He was quite excited. So what we did when in negotiations with him was, number one, we want a discount because we're buying in bulk, and that's very difficult to find in the build-to-rent asset class. But because he's never heard of the word syndication before and that's never happened to him, he was willing to work with us. So in the left-hand corner, you can see here, purchase to price is 12% discount to appraised value. We are literally making money on the buy because we're buying the homes at roughly $300,000 per home, and they're appraised today at $347,000. So the minute we buy this project, we're making money. The second thing we asked the builder was, we said, okay, we want nothing to do with development. August, my partner, has been a developer for many years. There's too much that goes along with it. We don't want any development risk. So you got to go get your own construction loan, completely separate from our loan, and you got to do the construction process, and you got to deliver the homes to us at certificate of occupancy. So that's really important for me to discuss that from the very beginning, because We're not taking on any development risk. All entitlement and rezoning risks have already been completed by the builder. He's getting his own construction related financing, so that's a check mark for us as well. Second thing is, we don't want to take on any risk of material or labor cost increase throughout the building process, throughout the development process. Again, this builder, 38 years, he's been through every cycle pretty much out there. And he said, no problem, I'm willing to take on that risk. I have all my trades and everything that I've been in contact with for many, many years. And that's something that I'm willing to work on, and we will give you guys a locked in price for this acquisition. So those are the main elements that I really wanted to touch base on before I dive in deep. And then the last one is, it's an extremely rare infill property. So this infill piece of land, over a million people in Tucson. And this is, I believe, the only infill property piece of land that's right in the middle of a very dense urban neighborhood. It used to be an old school. They knocked it down. He actually bought the land 4 years ago. Hence why all the entitlements and rezoning and everything's ready to go. So we're really excited to, have access and be part of something that was extremely rare to find. And if there's questions along the way, ladies, please ask away. Now let's go over the investment summary. This is a 68-page document, but I am going to just hit the key points for this presentation today, and then I'm going to share this presentation with everybody after. So this is a $21,500,000 project going in at a fixed price. We're going to be raising $6.8 million, and there's going to be 71 homes. So 71 home, brand new community. They're detached. They all have double car garages. There's 3 different floor plans. And again, they're going to be delivered to us at certificate of occupancy. So a couple of points I wanted to note on here is, we're forecasting stabilizing the asset after 18 months. So that means we'll have it fully rented out, all 71 homes. We're going to be pre-leasing the homes now before they're built. And then shortly thereafter, we're going to be refining, which in the above market cash on cash, and I'm just going to get my little pen out here so that everybody can see. How do I share the pen? Do you know how to get the pen, Joan?
I don't.
There's a little pen that I like. That's okay, I'll use my mouse. Right here on the bottom, you can see my mouse, right?
Yeah.
Okay, perfect. Right here on the bottom, you'll see above market cash on cash of 8.5% returns will be into the benefit of the investor. So it's going to be highly cash flowing essentially once we refi and have it fully stabilized. So that's one of the cash on cash is just an important metric that you guys would probably want to see. And then again, on the right-hand side here, you can see these above market returns that I'm actually going to break down for you in some slides to come. And we have three different classes of shares. Now, on the compliance side, this project is reserved for US and Canadian accredited investors. However, I am working with my legal team right now because we have a little bit longer of a timeline to raise on this deal to get them to create something called an offering memorandum. And that's an exemption that I can use to raise from non-accredited investors. So I've particularly been working hard to bring a deal to the table that will allow non-accredited investors to participate. And I think this is going to be the one that we finally are able to partner up with non-accredited investors as well.
Ava, can I ask a question?
Please.
Before you move from that slide, because I'm sure lots of people maybe also have the same question. I think we all totally understand the annualized return, right? Like the average annualized return. What can you define average cash on cash and tell us what that means?
Yeah, what it means is it's an aggregate of the 5-year holds. It's going to be a 5-year hold period, and it's over the 5 years. What's the average cash on cash? So I can kind of go through that, but the cash flow there's no cash flow in year 1 because there's no properties that are rented out, right? So usually from the rents we collect on a typical multifamily, you're cash flowing from day 1, right? Because you're buying a stabilized cash flowing building, and from the rents you collect, you can pay your mortgage, taxes, expenses, all of your fees, third-party property manager, and still have enough surplus left over to give your investors cash flow. Right. Now on this project, because we're literally going vertical and our first tranche of homes will be delivered to us in about 8 to 10 months, the first year there's no cash flow.
Right.
But the year two, because we're going to be renting out some of the homes, cash flow might be 3.3%. And then it grows to 5.5%, and then 7.5, and then 9.5. And you take all those 5 years, and it averages out to an 8.5% average.
Right.
Perfect.
Thank you.
And I'll definitely go through the cash flow and how everything works and what a preferred return is and all that fun stuff, because it can be a little difficult to understand at first, but all of our deals are exactly the same. So once you get it, you'll right away be able to catch on for all the upcoming deals as well. So these are just some, things that we love putting in these deal presentations. We're pretty much trying to prove our case why we love, this region so much, and particularly the area. And we're a real estate private equity firm. We're regionally diversified, as Joan was mentioning. So if we're looking at a certain region to invest in, we're looking for certain growth metrics, such as job growth, population growth, income growth, and rent growth, which Tucson definitely has. So little things to note, it's a perfect match for remote workers. It offers a great lifestyle and variety of work from home opportunities. So it's ranked number 5 among the 7 best cities for remote workers. The region employment has been growing since COVID, and it's actually back to 100% of pre-COVID employment numbers. I'm going to be sharing some of the demand drivers in a few slides later, but we're also very thrilled about the location of the asset because of its close proximity to so much jobs and commerce, such as the University of Arizona. We got the Tucson International Airport. We got the military base. All of this is less than a 15-minute drive from our asset. And I'll show you guys some other things that are really close by. So the next few slides really proves our, we want to talk about build to rent asset class because it is a newer asset class. But right off the bat, everyone, I want to let everybody know, build to rent, single family rentals, they operate exactly like a multifamily. They're valued exactly like a multifamily. So you can almost look at it as a horizontal multifamily. That's just the way it is. It gets valued on the income approach. This particular asset, we're actually buying it on the comparable approach, and we're selling it as the income approach in 5 years to an institution, most likely. So that's something cool about this particular deal. Some fun facts about build to rent, and it'll all make sense why we're so excited about this asset class. But on average, rents are 20 to 25% higher than the conventional multifamily. Lower turnover for tenants because you get a stickier tenant because it's kind of like their home, right? They're living in it's a detached, again, single family home. They have their own walls. They don't have somebody above, below them. They have their own garage for safety. Women can get right out of their garage, go right into their home. So you got a stickier tenant. Single family build to rent rents reflect higher income tenants as well. Maintenance-free living, more privacy, and again, improved level of security, as I just mentioned. I'm not going to go through everything on these slides, but some of the key things that I want to talk about is particularly this slide here. A lot of people are being priced, a lot of families and people, but they're being priced out of being able to afford a mortgage to get their own home. So you have these families, interest rates hiked like substantially in the last little while. A lot of people are being priced out of being able to afford a home. Now, what is their option? They have to go and find a place to rent. In most cases, for $1,800 to $2,000 a month, you're probably going to be looking at renting a condo unit, right? So for families that have kids, it's probably not the best scenario for them. So this is a perfect opportunity for families to be able to come rent a property from us for $2,000 a month, have their own space, and have room for their families. That's number one thing that I wanted to mention. Build to rent serves a larger demographic as well. You have the baby boomers who don't want maintenance-free living and they don't want to live in a condo, but they still want a home, and they want a bungalow. They don't want that 2-story where they have to walk up and down. This is perfect for them because we do have 3 different floor plans. And then again, you have the family where we have the 3-bed, 2.5 baths, and it really serves the millennials as well. So that's one thing. Second thing is working from home. After COVID, everybody kind of, started trickling out to the suburbs. A lot of people are working from home now. 6% of people were working from home pre-pandemic. 15% of people are working from home today. People want their space, let's be honest, for their mental health and also for just space from anybody else living in the home. So this is a great opportunity as well for them to, have their own space and go from there. Arizona is extremely hot. We all know that. So having a garage as well, and you're not parking outside in the parking lot is very beneficial as well. So we're excited to, people can actually drive right into their garage, don't have the sun heating up their car, and it'll cool them down a little bit as well. Again, this just talks about the rising mortgage rates make home ownership less attractive. And we did some studies, and I'm going to show you ladies shortly, of rent compared to own, rent from Corbett Village Homes compared to own. This is actually a rendering of the property as well from a different angle, but you can see it's very low maintenance landscaping on all of our multifamily assets. We have like this big pool, we have a leasing office, we have the gym, we have all this maintenance, high cost maintenance that we have to keep up on. So our bills are low when it comes to this property. So it actually really benefits us on that side of things too. Any questions so far? Good to go? Perfect. Let's get into the fun part. Let's talk about the investor returns. So we have a 3-tiered equity structure that allows for investors to really choose what option works best for them. We have the Class A, Class B, C, and then we have just the three classes. But I want to really go through each one, and then it'll all make sense on how it works. But just right here, before I go to the next slide and really talk about the returns, this is called a capital stack. It really lays out who gets paid in what order. So of course, from the rents we collect, the debt always gets paid first. After the debt gets paid, Class A investors are right after the debt. And I'm going to explain what the returns look like for Class A investors. Class A investors get paid first, meaning the risk is a little bit lower than the Class B and C investors. But that also means that the returns are going to be lower. Lower risk, lower returns, higher risk, higher returns. So Class B and C investors get paid right after Class A. And the general partner, CPI Capital's team, we don't get paid until all of our investors get paid a preferred return. And I'm going to go through what the preferred returns are. So this is a performance-based investment we have to perform in order for us to get paid. So it kind of lights our feet to the fire. Here's the different classes of shares. So we got Class A. And please keep in mind, all numbers are in USD. All returns are also done in USD. So my Canadians, you can call your institution, your banking institution, say, hey, I need a USD account open. And it's really as simple as that. I do have some Forex companies as well that I can share with you, ladies, if you need. But Class A is a minimum investment of $100,000. Class A investors get a 10% preferred return across the 5 years. They do not participate in the upside. Okay, so they get their 10% every single year, and it's a preferred return, meaning that you have to get paid 10% first, and we owe you that before we take any of the profits in the back end. So that's how Class A investors work. Class B investor is a $100,000 minimum investment. You get an 8% preferred return, again, meaning you get your 8% every single year until there's any split in the back end, which is a 70-30 split down here, in favor of the limited partner. So preferred return means the investor gets paid first, and then anything above that, we split 70-30. So that's really how we get paid as general partners. We call it a 70-30 split in favor of the limited partner. So 8% pref. Now, you go down to average annualized return, and it's close to 30%. That 30% includes the cash flow and the profit made on the back end, put into one, and that means that's your average annualized return of 30% with all the numbers combined together. Okay, Class C investors, really the difference is it's a minimum investment of $50,000. It's a 7% preferred return, and the only other difference is you're getting 27% average annualized return, but the minute that you hit, and it says down here, 15% IRR, we're predicting a 19% IRR, but the minute you hit 15%, anything after that 15% is split 50-50. Anything before that is split 70-30 with the Class C investors. So we're really kind of trying to incentivize investors to invest a little bit more and go for that Class B share. So that anybody can please ask questions if you have questions, and we can dive into some of the numbers a little bit more. But this page really breaks it down, Joan, on the cash flow assumptions based on each investment option. So this is, of course, this is net all of fees. This is what you're going to kind of walk away with. And this is before you pay taxes. Okay, so this is net all of the fees that are paid. This is after we get our 30%. This is what you ladies are going to be walking away with your 70%. But we do cash flow, and then I'll talk about the return on disposition. What we did was we kind of did things interesting on this. So it's a build to rent. There's no cash flow from day one, but a lot of our investors like cash flow. They're used to cash flow, right? They're like, you know, cash is king, and a lot of people want to see that at least something coming in. So on the Class A investment only, what we did is we said, okay, you know what we're going to do? We're going to start paying out cash flow right away on the project. So essentially, let's say we close in December, cash flow starts in January, and they're going to be getting $5,000 per year of cash flow distributed monthly. So we do monthly distributions. So that's for the Class A investor. Class B and C investors, their cash flow does not start until year 2, and you can see how it grows. It goes 3.3, 7.4, 8.7, 9.5, and it starts growing as we stabilize and as we improve things. But essentially, you're looking at this and you're saying, okay, year 1, I didn't get any cash flow. But we promised you guys an 8% preferred return on your money every single year. So what that means is it actually means the first year you're making 0%, but you're actually making your 8% preferred return. So what happens in these investments when the returns are actually cumulative and compounding? What happens is that 8% gets added onto year 2. We owe you another 8% in year 2. So that means we owe you 16%. But we're going to be paying you 3.3%. Anyways, it keeps rolling over 8% every single year until we sell in the back end. You get paid out 8% for 5 years, and then the profits made above that are split 70-30. Does that make sense? Yeah? Okay. Please stop me if anybody has questions. Same thing for Class C investors. You're getting your 7% preferred return every year. So you invest today. You're not getting any money in your pocket, but you're still making that $7,000, or let's say, sorry, $50,000 investment. You're still making your 7% the first year. It's just going to be paid to you later as the cash flow starts coming in. So that's essentially how the preferred return works. So your money's working for you. You're just getting it paid a little bit later. And this is just as a return summary. We always like to give a range on where we believe this asset, you know, could end up for the average annualized return. We don't want to give you an exact number of, 29.6%. We want people to know that this is a, valued on the cap rate at the time. So what we did was we did a cap rate, exit at 4.5. We highlighted this here because we called a bunch of brokers and we were trying to predict what the cap rate would be in 5 years when we exit the project. We did a 4.5%. This is very conservative, as a lot of brokers that we talked to were talking about 3.5%. So we always want to underpromise and overdeliver, particularly on this deal. We ended up going up a whole percentage in cap rate, but this gives a good example. Hey guys, if we exit at a 5 cap, your returns are going to look around 21%. If we end up exiting at a 4 cap, it'll be around close to that 40%, which is substantial returns, but we want to be conservative. The acquisition process timeline. So on a high level, funding deadline is in October. November, we start the construction. 8 homes are delivered to us next year in July. All of the 71 homes are going to be complete in April 2024. We're going to be obviously pre-leasing the homes with our property management company before the first 8 homes are delivered. And then in May 2024, we're going to be refinancing to a permanent agency loan, which is going to have a much lower interest rate at that time. And then in 2027, we're planning on selling the property to most likely an institution. These are some numbers. I just kind of already went over a lot of those, but I'll share this after. The next few slides, I'm really just going to be making, our case about why we love Tucson so much. What you really need to know is that it's a population of about 1.1 million people, and there's less than 1,000 units that are currently under construction. So the city is full of jobs, which I'm going to go over in the next couple of slides, but it really does have an immense hunger for housing supply. There's about 6.8 million units across the US of housing shortage right now. And we're really proud to be investors that are going there to build single family homes for people as there's such a shortage right now. These are just some really key metrics on the area as well. And then I wanted to focus on this slide because rents are poised to grow 14% this year and next year. However, in our underwriting, we did a 3% year over year rent growth. So again, being very conservative with our numbers, we just wanted to point that out to people as well. So, you know, Sunbelt states, it's ridiculous how much rent growth they're seeing. There's no rent control. So as landlords, we're not limited to only increasing the rents a little bit. We go with what's happening. And when people are flocking and there's a huge immigration happening where, you know, people are coming from California and New York to these lower cost of living states that are sunny and you know, business friendly, that's just where we've been seeing this incredible rent growth on our properties. I mean, our property in Charleston, South Carolina, rents went up 20% in 1 year. So what does that do? It increases the value of the asset for our investors. All right. This slide here, guys, just really shows the proximity. And this right here, it's supposed to be highlighted green, but this right here is an infill parcel of land. You can see it's all this urban, dense, like neighborhood around it. So we're located right here. And we put some numbers on the page here because location is everything. But we got downtown Tucson, 14-minute drive, University of Arizona, 15-minute drive, the airport's 17 minutes, Tucson Air Force Base is 8 minutes, Space Museum, 13 minutes, the hospital's 8 minutes, Amazon's really close by, and then we have Raytheon. And Raytheon is an 18-minute drive, and Raytheon, which is right here, just got $1 billion, what is it called? Hypersonic missile contract. So there's going to be a lot of jobs that are going to be close by. So these are all the area demand drivers, and we want to be right in the middle of these. Not to mention that our property is really close to a couple Costco's, a couple Walmarts, and we kind of just put all this stuff on. We're right here. We're literally right here. And what my team did was we did up some renderings to really show you how close everything is. So you got Costco, you got the Walmart. Of course, if they build there, you know that you're in a pretty good location. And again, another Costco, another Walmart, the mall, and everything like that. This is a study that we did because sometimes, you know, as landlords, you lose people. They go and they rent, they want to go and they want to buy their own home. But in this study, what we did was we wanted to show people renting versus buying. So really the difference you'd have to pay is $185 to close to $800 a month more in order to buy a home. That's not including the down payment. So the percentage increase to own versus rent is close to 40%, and then of course down to 9%. But this is a study that we wanted to do to really show people the difference in pricing. And then we did, you know, single family average home price is $347, and their monthly payment is $2,200 up to $2,900. And then Corbett Village homes, our rents are going to be around that $1,800 to $2,100, depending on the floor plan. Property specifications, unit mix, super important. We have, you know, three bed, 2.5 bath, 3 bed, 2 bath, and then we have the urban, which is 2 single-story floor plans. Again, serves a larger demographic. And then we have 18 2 bed, 2 bath. But everything is going to be really low maintenance in these properties. So we're going to have the vinyl plank flooring, stainless steel appliances, quartz or granite countertops, 30-inch cabinets, and so forth. Washer and dryers provided in each unit. Again, this is just a high level of the percentages of what each floor plan is. And these are the actual homes that we're building. So this is the 2-bedroom, 2 bath. And this is like the Arizona style. It has this kind of this look and feel. The same builder actually built a property I'm going to be showing you in some slides. It's about a 15-minute drive away from this one, and they're really, really nicely built. This one's 3 bed, 2 baths. And this is our 2-story, which is 1,624 square foot. So great for the families. This is just the site plan. on a high level, you can kind of see where each floor plan is going to be laid out. And then let's talk about the debt a little bit. So the debt is really important for a lot of investors, particularly right now, because we're in a increasing interest rate environment, and a lot of people are asking us, what's happening with the debt. So essentially what we did was we got our loan approved by our lender, Corbett, and we're getting a $17,240,000 loan. And what we're doing is it's essentially like a line of credit. And the line of credit is collateralized on the equity that we are raising. Okay, so in the finance world, this is actually called a pledge of equity debt. Really cool, unique opportunity for us in the increasing interest rate environment that we're in right now, because essentially here's how it works. We're going into contract today at a forward contract with a fixed price. And how it works is today we're getting the loan approved. We are not taking from the loan until we get our first tranche of homes from the builder, and it'll be probably 8 to 10 homes. Once we get that and we're finalized, we take from our line of credit just what we need, and we're only paying that high interest rate on the little amount that we need at that time. The next month, we get the next tranche of homes delivered to us, and we again pull from that line of credit that we have in place. And again, we pay just on the little bit of debt that we take at that time. Unlike a multifamily asset, if we were buying multifamily, we'd have to get that $17 million upfront today, and we'd have to pay a very high interest rate on that amount today, which is a little bit scary because interest rates are very high. So essentially what we're doing here is we're literally just taking it as we need. And then once we're fully stabilized in 15 to 18 months, we're going to be refinancing to a much lower interest rate, of course. So again, it's kind of a unique opportunity today because we don't have to pay that high debt. And hopefully by that time, 15 to 18 months from now, things stabilize a little bit more. Inflation is, levels out a little bit more, and interest rates come down. So that's what we're hoping for, but that's exactly how our debt's going to be laid out on this project. This is just a snapshot from the underwriting. It's just showing, marketing costs, landscaping, payroll, really just all the management fees and all the assumptions and the cash flow assumptions as well. So this is just a whole lot of numbers. If you want to take a look through it and ask any questions, by all means, we can answer that for you. Everybody wants to see rent comparables. There was no properties that were similar to ours. Again, this is a very rare opportunity. So we did have to use comparables that were apartments. So what my team did here is they actually they minused and added some different things on the Corbett Village homes here. For an example, a 2-car garage, we gave it an extra $250 value, as opposed to all these apartments. They don't have those, obviously the garages or the fenced yards or anything like that. So we kind of averaged it out. And you can see here, about 12-minute drive from the property, there's, these 1980 builds that are renting out for $1,750, $1,800 a month. Ours are brand new homes. This exact builder built a 53-unit community, sold them off one by one to single-family, to just average buyers that obviously just bought the home from him. But they are renting for $2,400 a month, the exact same floor plan. So this is kind of, again, where we've been conservative, and we're looking forward to bringing the rents up to market value when we get to that point. This is a 3-bedroom apartment comparable. Again, you can see $1,900 a month, $1,837, $1,869. Again, we're $2,182. That's for a 3-bedroom. And yeah, this is kind of what we had to compare with. So again, I'm pretty sure people, if they can be in a home compared to a condo, I'm sure they'll go with a home. Just about done, ladies, but most people say, okay, what's the risk here? Like, what is the worst case scenario when I'm investing in something like this? The worst case scenario is we can't get anybody to rent these properties, right? The worst case scenario, or on a multifamily, is if everybody moves out of the building. We always want to know, and our investors want to know, what is the worst case scenario? What I always say to them is, let's talk about the break-even occupancy sensitivity analysis. And that means, okay, where does the occupancy have to be at just to break even? Anything below that, that's where we do something called a capital call, which we don't want to have to do. Okay, so essentially that's why we follow certain growth metrics. We follow the data, where are the big companies going, where are the jobs going, where are people flocking, because we want to make sure that we have tenants to rent out our properties. So we would have to get to below 67.6%, and that just breaks even. So that means from all the rents we collect from the 60% of occupancy, we can just pay our debt and all of our operating expenses. All of our properties right now are at 98% occupied. And this one, I don't think we're gonna have a problem renting it out whatsoever at the lower rents as well. So that's the worst case scenario in a business, in the model like this. And that's where, again, we start looking at history. Okay, 67% occupied. How did you guys perform during COVID? How did you guys perform? How did this asset class, we had properties during COVID, but how did this asset class perform during the 2008 financial crisis? We start looking at history, and multifamily build to rent was one of the best performing asset classes out there. Really so much so that unfortunately during COVID, my sector went super competitive, and all of the other sectors like hospitality, industrial, office, they all started flocking to multifamily because they just went totally down. So we were okay. Of course, government stepped in, started, printing trillions of dollars, and our rents were paid. And to be honest with you, our distributions to our investors were not affected at all during COVID.
Do you know what the vacancy rate in Tucson is?
The vacancy rate in Tucson is very low. It is 3 to 5%, and I can confirm that, but it's very low. Yeah, good question. I have the number on the tip of my tongue, actually, because we were just discussing this the other day. That's why I had to say 3 to 5%. That concludes the presentation for the Corbett Village Homes. This is just our multifamily portfolio. All of our assets, again, are in the US, except August is working on one in Richmond, British Columbia. It's a development deal. He's still working on it today, but we do have a total of 995 units. And this will be our fourth, I guess you can call it our fifth project that we're doing. But this is our Braxton Waterlea. This one's in Orlando, Florida. Hurricane Ian did not affect it too much. There was a little bit of damage. We were highly insured on this property. But yeah, there was a little bit of a mess, but nothing substantial. This is our property in in Charleston, South Carolina. It's called the Blue Water at Bolton's Landing. Performing substantially well because rents have increased quite substantially. This is our value add property in Houston, Texas. Right now we're renovating, and we on all of our assets we got something called an interest rate cap. So when interest rates went up substantially, we were covered pretty much, because it's kind of like an insurance policy that if interest rates go wild, then we're capped out at a certain interest rate. So again, that's something that we put into place to mitigate risk if the environment ever was in this type of environment. So we really covered ourselves there. So I was excited to call our investors and tell them that everything's going to be okay. Little bit about the builder. 38 years of track record, built over 2,200 homes, developed over 40 new communities in Tucson. I've already met Steve Crawford. He's one of the guys right next to Bill Viner. But Bill Viner, he's a 75-year-old guy, been in the business for 38 years, and we're going to be taking him out for lunch this month. These are some of the recent homes that he's already built. This is the community that I was actually walking with my team just last month. And then we always have a third-party property manager. So unlike Canada and the US, you literally hire a third party. They take care of everything. So they take care of the renovations, they take care of the leasing, they take care of pretty much everything that you could imagine, and they're full service. So that's on all of our assets as well. We've hired a company called FCA. FCA, they're superstars. And then in Arizona, they don't do Arizona. So we are going to be partnering up with Valley Income Properties. And they're just experts in the area. So we're really excited to work with them. This is my superstar team. And then some real estate terms and definitions. And again, just another rendering of the asset. So that's it, ladies. I got it done in, I don't know how long, hopefully.
You did very well. You did very well.
Thank you. So hopefully I did an okay job presenting it. I know the numbers can be a little bit confusing at first. Preferred returns, IRR, all of these kind of weird terms. But if you ladies have any questions, I would love to answer or clarify anything.
Anyone have any questions for Ava? Everybody's on mute.
That was well done. That was a lot of information. Thank you.
Yeah, very, very good. I think this is really interesting because I think this is the first time we've looked at something that has been not necessarily a development, but a development that is staged the way that you're proposing it to happen with the financing structure, the way you're proposing it, I think is unique and very interesting because you're acquiring homes slowly and using the debt slowly, which I think is really quite interesting because it allows you to get those homes in the market. It's almost like building a multi-phase development in the sense that first, if you're building, say, 3 multifamily buildings in a development, that first building is always the key indicator of what the rents are going to be and what the market looks like for the next building and then the next building. So I think that's interesting. Now, being that you're doing it in stages, would there ever be like a shotgun consideration for stopping the development if there were some type of disaster, let's say? Not to predict that there would be, but the unique thing about doing it in stages is you almost have a little tiny bit of a safety net too, to say, pump the brakes, all of a sudden, maybe this is a disaster. Another world pandemic has happened and everyone's flocking away from the sun for whatever reason. Unlikely to happen, but because it's being staged in different deliverable dates, is that also a safety net?
That is a safety net, right? Because again, if the builder doesn't deliver, we don't have to pay him the debt. So it's not like he's getting the 17 million up front and we're like just praying and hoping that things happen, right? He has to deliver the homes in order to get paid. So we actually have full control over that. Another thing I forgot to mention is each individual home is individually titled and individually metered. So if for whatever scenario, say in 5 years, we can't sell it off to an institution, which is very, very rare, we can actually sell off each home one by one. So that's also for risk. That's also a huge benefit for us.
Yeah. So it's not like a stratified complex then.
That's right.
They don't sit in, right. So that is actually a plan C potentially, or a plan D is to actually just sell them on the commercial market.
Yeah, exactly.
As individual homes.
Yeah, exactly. This deal really ticks off. Like, people are a little bit shocked on all of the check marks on this deal because it is very rare to find a deal that kind of has all this in there with the risk, right? A lot of the time you're kind of taking on development risk. You're getting returns that you would almost get on a development deal. Or on a deal that is an opportunistic deal, meaning that there's a lot of value that needs to be added. So usually the higher the risk, the higher the returns. We're getting a little class A asset, and we're kind of getting opportunistic returns from it. So that's kind of the key why we're really excited about this deal.
Well, and the risk is so low from the development side because you're not developing it. Right? Like if we're going through this with Crown Capital right now with the Campbell River property. If you, once you contract the builder and you press go, you're paying cost plus or whatever the deal is then. And so if prices go up or there's some worldwide shortage on steel, which we've seen happen before, or the forest fires take out all the wood, or some mills shut down, or whatever it may be, all things outside of our control, you're already committed. Whereas you have the opportunity, like you said, if the builder doesn't come through, he doesn't get paid. You don't front it. You are literally paying for it as you get it, and that is actually super reassuring because you've got an actual hard asset.
That's right.
To receive before you need to put out any money, which is the opposite in the development world. You need to put out a lot of money before there's even a peg in the ground. So
Absolutely. And honestly, right now in the environment we're in, investors are reading the headlines, they're scared. We wanted to bring something to today's environment where they can feel safe.
Yeah.
They can understand that, you know, because a lot of people, you know, the first time they seen this, they right away thought development. Development deal, oh my God, what's the yield on development? I don't want to, you know, what about cost increase? And that's where we really pushed in negotiations and said, listen, we know our investors, we know what we want, this is how we want it. And we were able to work out a great price and a great deal with all these risk mitigating factors that kind of make investors feel a little bit more safe right now.
Well, it's definitely unique. I haven't actually seen anything like this format presented. So,
well, Joan, this is why we're so excited, because we are literally one of the leading syndicators to bring the build to rent asset class to retail investors.
yeah.
Because this is all, and I could show you ladies this chart, and there's billions of dollars being deployed in build to rent, all institutions, and they'll buy up like 1,000 at a time. They won't just buy little communities, they'll buy portfolios. So they'll buy, you know, 100 community here, 200 community there, 300 community there in Tucson in one region, and they call it a portfolio. For us, this is just a community. Now we're already looking in Tucson, we want to expand our blueprint. We're already looking at a 27 unit community. And then once we buy that, then we'll have a portfolio. Right. And eventually one day we can sell off maybe our whole portfolio to an institution as well, because it'll be much more attractive to them, because the more we have, you know, the more they want. Like 71 homes. The good news is, again, is we're not really going to be in if it was like a crazy hot market right now, we wouldn't be getting this deal for a discounted price. We'd be in competition with others probably. You know, depending on where things, I don't even want to think about it if it was a hot market right now. All I know right now is a lot of people are pumping the brakes. When there's blood on the streets, we feel like there's great opportunities out there. And that's why we pounced on this opportunity, because you know, everybody's scared right now. They're sitting back, but I don't think anybody's going to find a deal that has all of these check marks in it.
Great. Ladies, does anyone have any questions of Ava?
Judy, do you have any questions at all?
Hi, Ava. I do have a question actually. So I think I was following the numbers okay in terms of, depending on which level of investment you go in at, that dictates the level of return. So when it gets to the point that you might sell it to a larger institutional investor, is there something in it for the investors at that point, or is it, which is also, you know, it's very attractive already, the annualized returns that are there?
Yeah, essentially what happens is when we sell it, all the profits we make, we split 70-30. So 70% goes to our investors, and then we keep 30% of that.
Okay.
So even on the buy, so I keep saying we're making money on the buy. So even though we're buying the homes today at 300,000 and they're already worth 347, so we've already made money. I had somebody ask me, "Are you guys taking a lift?" I'm like, "Well, what's a lift?" And I said, "Absolutely not. We're taking a lift. We're not taking a lift. We are sharing all the profits made from the day we buy it to the day we sell it with our investors, with them first getting paid their preferred return. So either 7% for Class C, 8% for Class B, or 10% for Class A. Once you make that, so let's say Class B, once you make 8%, then anything above that 8%, we split 70-30.
Okay.
Yeah, so our investors have to make the preferred return first before we make any profit.
Okay.
Yeah.
And I know it might be hard to predict the timeline, but it sounds like it's a 5-year investment, and then whenever you might be able to find, the timing is right to find a buyer, then that 70-30 would happen.
That's right. Yeah, the 70-30 happens when we sell. And we do say a 5-year hold, but do keep in mind that we're market opportunistic. If it's the right time to sell in year 3 or 4, then we'll sell. If we need to hold because the market plummeted, then we're going to hold. Our investors need to understand that, you know, our reputation is everything to us. So we're not going to say it's going to be 5 years and then we're going to hold it for 10 years and you're not going to get any money back, right? Because that wouldn't do us any good. But again, if the market's horrible, why are we going to sell our property when you're cash flowing at over 10% per annum?
Yeah.
You know what I mean? So, but our goal is to do around that 5 year.
Okay. And do you need non-registered or registered investments or both?
So this is a cash investment only. So we're not RSP eligible. Perhaps in the future, I think my team is looking into a couple different ways. We're not a trust, so it's really difficult to get RSP eligible when you're not a trust. We're a syndicate.
Right.
We're a syndication. So we're project specific. With that being said, I think there's some cool savvy things that we might do in the background to try to get RSP eligible though, for sure.
Okay. Okay, great. Thank you.
Yeah, my pleasure.
Ava, if I understood correctly, the fellow that's going to build this, you said he was 75. Does he have a backup plan? You know, at that age,
Good
you could get
question.
COVID
Very
or
good
something,
question.
and somebody has to take it all over. Do they, whoever takes it over, do they understand this deal so that they finish the project for you?
Absolutely. So yeah, his right-hand man, Steve Crawford, is right there next to him, who's much younger than him. But yes, there's a whole backup plan, a whole team to the side. God bless him though. He's pretty healthy guy.
Yeah, because I know you'd have it figured out, but do they have it figured out like at that age? That's what I was wondering about. Yeah.
Yeah, very good question. They do, yes. Everything is all set in stone. So if things were to happen, the project would still go on.
Good. Okay.
Good question.
Good. Anybody else?
Ava, I have a question. What if you don't get all your Class A, B, and C investors?
If we don't raise the 6.8 million? So typically how it works on these deals is there's always a non-refundable deposit that goes in. So you always want to make sure that you can raise the capital before you commit to these deals, because then you lose your money. So we don't ever enter anything unless we know for a fact that we can close. Bless you. You're welcome. So yeah, that's essentially how it would work. There's always, you know, these projects have this non-refundable deposit, and yeah, you got to be confident that you're going to be winning on that, because then you lose all your money. Yeah.
And then for the investors who have bought in, are the shares, I guess, assignable?
The shares are not assignable. What we do is you can invest as an individual or a corporation. And essentially what we tell our investors is that you're committed for the term of the project. So say something happens, again, God forbid something happens, and you know, divorce or death or all these scary things. There is an option that you can come to the GP and say, hey, can I sell my shares to yourself? Or is there another investor that wants to buy my shares off of me? That is something that we can discuss at that time, but we always want people to go into the project knowing like I'm committed for, you know, this amount of, you know, for the 3 to 5 years, and just know that that's a commitment made. But things happen in life, so that's totally understandable. So we can have that conversation when it comes to that.
Great. Anyone
Yes.
else?
Anybody else?
Maggie joined us late, and Rosie came in just after we started, so I think she got most of it as well.
Okay. Okay. Wonderful. And
Yeah.
there's going to be the replay. Ladies, listen, I am going to be doing, you know, I co-founded this company close to 3 years ago now with my partner. We started our educational platform about probably a year and 3 months before we even did a deal. Talking to Canadians and saying, hey guys, give me 50 grand. I'm going to take your money. I'm going to go across the border and buy real estate in the US. And essentially you're going to be signing off on a subscription agreement, which is a 200-page document that says, hey, I can lose all your money. Like that is what I had to educate and tell people the risks associated and how you're backed by a tangible asset. So we literally went all across Canada. We started educating on this concept that sounds extremely scary at first. You know, what is syndication? What is passive investing? What is a limited partnership? What, you know, what is an LP? Okay, I'm going to be a limited partner, meaning I have a limited liability, but what does that really mean? You know, so we probably educated, again, a year and 3 months before we even did our first deal, because what we did was we built up our investor community, and now we're able to go ahead and, you know, buy these projects. But on our first deals, we partnered with other groups. We're excited that this is now our own deal as lead GP. So this is something really exciting for my group, because we always wanted to be an operating real estate private equity firm. We didn't want to partner with others all the time, right? But when we first started and started building our track record and, you know, building traction here with Canadians particularly, we ended up partnering with other groups. We were able to take down an institutional asset. Of course, we couldn't raise, you know, millions and millions of dollars on our own on our first deal. So we were able to partake with others. And now this is our baby. This is our first deal that we're going to be doing as lead GP. So I just wanted to throw that out there. And this is going to be one of many. You know, we're really excited to, you know, educate on passive investing. But as we all know, this is a trust game. You have to build trust in the person that you're, you know, giving your money to. So if you ladies ever want to jump on a call with me, I would love to have a one-on-one call. Or another thing, Joan, I wanted to mention is we have an affiliate program. So if anybody knows anybody else that's interested in investing in real estate, please reach out to me and let me know. And you don't have to put your name on it. You can say, hey, I know this lady named Ava. She has this cool opportunity. And then from there, what we do is we give referral fees, and it's all compliant. We work with one of the best lawyers in Canada. We have a referral agreement that he's done up, and then we can work with people that way as well.
It's fantastic.
Yeah, good stuff.
Well, we have a lot of trust and faith in you in the WREN community. So I think that, you know, that's something that's really important to us, is that we don't really work with people that we don't admire, trust, and have faith and confidence in. So that's the wonderful thing about being inside this group, is when you become part of it, you become part of it because there's an implied trust and an implied relationship already. That's part of the tribe, right?
Yes.
So I know that, you know, we've worked with you for a while now, and Liza has a great deal of respect and admiration for what you and the rest of the team at CPI are doing. So yeah, I mean, this is a fantastic opportunity for us to see something that is solely yours, and celebrate that with you as well.
Thank you, Joan. And I know a lot of you ladies, like, I live in Vancouver. I know I can't make it every week here because we're all busy. I told Liza I have to start making it more on the Wednesdays. But we've had a few times where people came over to my house. And is there anybody here from Vancouver by any chance? Do you have anybody? No?
No, we got Toronto and Victoria representing tonight.
Got it. Okay.
Vancouver.
Okay.
Oh, what, Vancouver?
Michelle. Yeah, I'm from Vancouver.
Michelle's in Vancouver.
Okay.
There we go.
Okay, wonderful. Because yeah, it's once in a while we have the girls over here, and it's so much fun, and we get to have some tea and some nice conversations. So I was gonna say, if any of you ladies ever come here, just let me know, because we'll try to plan around that.
Judy just put in the chat, great presentation, Ava. So
Thanks,
she's
Judy.
probably having to get off because it is, what is it, 11:15. Okay, so for those ladies on the East Coast, we're gonna wrap it up. I don't have the long spiel that Liza generally does about what's coming up, because I got thrown into this at the last minute, so I didn't get a chance to do my research on what's coming up. But Liza will be sending out a newsletter, I think, before the end of the week. If she's feeling even remotely better, she may get it out tomorrow. But I think Jeff had mentioned that before the end of the week, there'll be some updated newsletter information coming out on all of the next few events. We did just wrap up the real estate summit that Liza hosted last week. Was it last weekend? Yes, last Saturday. Gosh, time is flying so fast. I think it was Saturday. I can't even remember what day it is anymore, in Victoria. And that was really great. It was a full day session. It was a great turnout. It was really great to get the gang together, and there was tons of information shared there. So I'm sure Liza will be doing, Liza and Jeff will be working on some recap on that as well for those people who were unable to attend. Yeah, that is it for tonight. Oh, thank you for being host. Thanks, Ava.
Thank you for being a great host.
Jeff called and said, "Oh my God, Liza's sick. We need a backup." And I'm like, "Okay." So anyway,
No, you're awesome. We all love you so much.
I apologize for not being as prepared as I'd like to be, but we made it through. And great presentation, Ava. Thank you very much. And again, the recording will be available in the next day or two. So if there is anything you wanted to go back and look at, you can go pause and look at specific screens. And of course, Ava is always available for a reach out. And this was an interesting, different type of cash flow crunch, but really it's all about the cash flow, right? So it worked out really well. So thank you, Ava.
Yeah, my pleasure. I put my email in there, ladies, if anybody wants to reach out and learn more. And if I can provide value to you ladies in any way, please give me a call. It's not just about this deal. I mean, I have a lot of connections. I know you ladies are probably working on your own things. Would love to hear about it as well.
Great. Thank you for that.
Yeah, of course. Okay, ladies, everybody has to get to bed. I'm like, it's 8 p.m. I'm like so concerned about everybody because I'm like, I know how important sleep is. So
does anybody have anything else before we wrap up?
No, that's it.
Hi, Maggie.
Great.
awesome.
Awesome.
Thanks. Hi, Maggie.
Thanks, everybody.
Thanks,
Have a great
Maggie.